So now as we turn to what's happening in Asia, one of the things that we've been talking about is these rate rising cycles. Many FOMC participants are ready for liftoff, and you're starting to see the movement in the U.S., which is really something that we've been very adamant about in terms of what was going to happen on rate rises and what that was going to do to yield. And then that has a knock-on effect of what does it do to emerging markets? What does it do to a lot of these pressure points? Because they price off of our 10-year, and we do think that, I think that the 10-year will be over 2% before midterm elections. I actually have, I think 2.5 beers riding on it as a friendly wager. And I think that those are going to be some of the pressure points. But while that is being said, the ASEAN nations, especially on the manufacturing side, have remained fairly strong. And that's something that we believe is going to continue as more exports originate from ASEAN nations and less from China. So now you have another three ports that have been either fully shut down, partially shut down in China. Ningbo, one of them, the largest in the world, essentially shut down, is going to drive people mad as they try to adjust supply chains, try to maintain a certain amount of continuity while these disruptions continue to appear and create these pressure points. And that's why when we look at China, the last real balance of economic growth has been exports, which we think continues to bleed into other nations, which we'll talk about when we go through South Korea, Vietnam, India, Taiwan, which have seen a big uptick in exports, and it's something that we think will be to the detriment of China. So then when we look at non-manufacturing PMI in China, the expectation was for 52, came in at 52.7. Non-manufacturing PMI. Manufacturing PMI was expected at 50, came in at 50.3, giving us a composite of 52.2. As we've said before, we think that this is a bit elevated. Things were a bit better in December, though, versus where they were in November. And the reason why we say that is because we did have the PBOC opening up liquidity a bit. And it's not so much that we were getting this huge surge of stimulus, but you did get the flat line, as we talked about, where you started to see credit impulses turn up a bit, borrowing increase. They opened up, property developers to get new money, at least some of them, which enabled some of this. But again, it's still a flash in the pan. We don't see this as something that's going to be continuous. We see a lot of pressure. Manufacturing got a bit better, but it's the non-manufacturing, it's the consumer, especially the local consumer, that is going to struggle and is going to be the underlying problem. When you look at CAIXIN China PMI, expected at 50, came in at 50.9. That's a bit closer to what we were expecting in terms of that 50 and a half, 51. But this is going to be something that we think is going to become a bigger overhang as we get out of Q1, especially into Q2. And now when you look at the internals, so China manufacturing PMI, where it shook out, but future output continues to come down. And that's when you look forward, which is why we talk about what does it look into Q1? What does it look like into Q2? The leading indicators are showing us that things are not as strong as they appear. And you're seeing this pivot, especially from China into other ASEAN nations, which again is going to put pressure on their underlying growth profile as we progress through 2022. So input prices did get better, coming just above expansion. As we've talked about, we do see this maintaining a certain amount of resiliency. It's not going to come into a contraction, but it is going to open up the ability to ease a bit, which is when you look at job losses will trigger more aggressive policy easing. But the problem is, they're losing jobs. So jobs are coming down in China. And if you think about everything that they've said, which is stimulate spending, we have the dual circulation strategy, we have common prosperity. Well, even though they've said it, they haven't actually carried it out. And that's when we look at jobs, when we look at what they've actually done. They're saying nice things, but we haven't seen it go to the consumer. And now this is just going to be another overhang for stimulating local consumer growth. So then when you look at what has happened so far in sales revenue, Q3 versus Q4. Now, remember, one of the things that we've been talking about was that Q4 was going to continue to get worse. So when you look at China Beige Book, you look at revenue, sales revenue, CapEx, profit margin, workforce, sales price, everything has continued to get worse. And that we don't see that adjusting into Q1. We do see it stabilizing. So we don't see it being, it could, realistically, it could be slightly better than Q4, but it's not going to be this huge surge where we're right back to where we were for Q3. It's going to be this stagnating piece. And why? Because there's a lot of pressure points. For an example, Evergrande is working to avoid an onshore default. It suspended trading in its 4.5 billion yuan bond, puttable January 8th. Proposed to delay the option date and coupon payment by 6 months and insisted this adjustment wouldn't trigger a default. So again, they're trying to play things around. They're trying to move things about to protect from additional defaults as we see the pressure rising. All the while, when you look at the small, medium enterprises, their cost of borrowing is going up. The large enterprises, they're coming down. So the banking system is struggling to meet loan quotas while keeping bad debt under control. Chinese banks rushed to meet their annual state-imposed lending quotas last month by buying up low-risk financial instruments rather than issue loans. In fact, this has been the heart of the problem in the Chinese economy for the last 10 to 15 years, with the banking sector responsible for boosting economic activity to meet high GDP growth targets, but in doing so, has run up enormous debt that cannot be repaid, which is why we talk about shadow banking. We talk about shadow debt. We talk about why there is such an issue. And when we made the call back in February of 2021, the view was, well, everything you just said is known. It's been known since 2011. Yes, but when you do it for 10 years, 12 years, 13 years, it compounds. It adds up. When you look at the debt to GDP level, for every $3 borrowed, you made $1. That is not a sustainable system, which is why I really don't think we're going to see the easing that people are hoping for or expecting, because they physically don't have the running room. Because you're constantly rolling over hidden bad debt, which is why the PBOC, the CCP have tried to have them pull that forward so that it's no longer hidden. We know what we're dealing with, but it's still out there, and some of it is hidden. And this is one of the big things, which means it will always coming out. And so now when we look at the end of the day, Beijing can still only choose between getting debt under control and accepting much lower GDP growth rates, closer to 2 to 3%, or realistically just continue this game. But I don't think the game can be continued, which is going to result in much slower GDP growth over the next few years. So then when you look at the spreading cost of borrowing money for China's smaller firms rises. So small companies, and again, back to what we had shown earlier, it's become more expensive for smaller firms to borrow, which, if you remember, that is the exact opposite of what they're trying to accomplish. They're trying to get small companies to borrow more at lower rates to protect jobs, which we've seen jobs have come down. Rates have gone up. So the gap between the interest rates on loans for small and large companies surged to 2.73%, the highest level since the survey began in 2012. That's despite a series of policies aimed at helping smaller companies and the central bank guiding overall credit growth to pick up in November to counter slowing economy dragged down by property downturn and sporadic COVID-19 outbreaks. Again, why we're so bearish on where China is going to end up for not only 2021, but also into 2022. China total property demand share of China total percent of property demand shares of global demand. And when you look at what is happening in commodities, so China demand and then China property demand. So how much of that is going to be consumed into commodities? And here you can see that the demand for iron ore is almost 80%, with almost 40% going into the property side, aluminum. So you can see that as the property remains an overhang, that will pull down that underlying Chinese demand that we've been talking about. But China developers face more maturity issues in 2022. Just look at January. Evergrande Group says they have to demolish on order 39 buildings at Ocean Flower Island, but they're saying it doesn't impact the rest of the development. I call BS. I'm sure other people will. And this is just showing the amount of debt we have to look at, which is why we've talked about January, March, and April as big months. And this is why there's going to be a struggle of how much easing can the PBOC allow to roll some of this debt that is clearly bad debt. It's been hidden, and now it's being pulled to the forefront. And we do think we see more bankruptcies and defaults as we've already seen, where when we get to the end of the grace period, which is why if you think about the 30-day grace period, February is going to be a very interesting month. So now when we look at industrial profits remain under pressure, we see that continuing through the end of the year due to gate prices going up, some of the inability to pass on some of that cost, which again has hit Chinese companies and especially profits. Now, when we turn to Vietnam, one of the countries that I've been bullish on has been Vietnam, and this is kind of giving you an idea of why. So exports were expected to be at 13.1%, came in at 24.8%. CPI, fairly manageable. GDP was expected at 3.9, came in at 5.2. Imports, slow to touch, was expected at 15, came in at 14.6. So we will start to see some reduction in exports, but still be elevated, still be strong in general. Retail sales down 3.8%. The retail side is where we're not as confident in when you're looking internally. It's more about how they're going to impact and trade into the international market, which is going to support industrial production, which last month was at 5.6%, came in at 8.7%. And then manufacturing PMI came in right in line at 52.5%, which we think is going to be fairly stable and strong through the rest of Q1. Now, when we look at South Korea, consumer confidence dipped a bit as you had a little bit of an increase in COVID, but business survey, business survey manufacturing a bit better, non-manufacturing a bit worse. Again, local consumption remains the fear, but industrial production was expected 3.4%, came in at 5.9%. And that's really because we continue to see strong exports coming through. CPI, a bit above expectations. We continue to see that coming on board, which is why we see them kind of maintain that rate hike. They've done it every about 25 basis points each time. We do see more of that as they're trying to get inflation under control. Department store sales dipped a bit from October to 18.3%. Discount store sales dropped 10.3%, which is a negative, and retail sales year over year came in at 9.6%. As we've been saying, retail sales, local consumption is where we see a continuous problem in Europe and in the ASEAN nations, while their exports remain robust. But if you think about it, if people aren't buying, well, eventually that's going to come down, but you still have supply chain issues, you still have inventory issues, so that's where you're going to get some of this support. Exports, though, missed expectations. They were expected at 23.9%, came in at 18.3%, while imports were expected at 40%, came in at 37.4%. Still showing imports elevated. Exports, again, will remain robust, and we still see that being a positive for South Korea. And the manufacturing PMI stayed strong, coming in at 51.9 versus 50.9 last month. And this is just looking at where South Korea's CPI is. You can see it remains elevated. You continue to see it push up, which is when you look at excluding agriculture and oil prices. So things that aren't going to fluctuate all that much continue to go back up to the all-time highs, which is why we see the central bank maintaining a very tightening situation versus loosening to try to keep this inflation in check. And South Korea manufacturing production right in just above trend line. We don't see it varying too much at this point because we do see exports remaining elevated. And now retail sales unadjusted for inflation, look very good. But then when you adjust it for inflation, you can see that there is starting to get some of that pressure that we're seeing in other areas. While when we look at exports, even though they missed estimates, you get an idea of how strong they remain and how this remains a bright spot for the economy going forward, not just in South Korea, also Vietnam, and what we're starting to see in India. Now, when we look at Japan, when we look at industrial production, had a nice pickup from 4.8% to 7.2% year over year, expected 2.9, came in at 5.4. Something that we expect to continue to see on the industrial side. But when you look at the economic recovery, you can see that the pandemic has hit Japan very hard, and we haven't seen the same type of recovery, and we don't expect to because of the debt problem, which is, when you look at what they've done by buying so much of their debt, they've really created this negative feedback loop, which has then created this low growth or no growth or negative growth setup, which we still see as an underlying problem going forward. And this is impacting more directly local sales as the Japanese retail trade, trades continue to underwhelm. And it's something that we think is going to be a problem, especially as we come into the new year. Now, shifting gears into India, the 8 infrastructure industries were at 7.5%, came down to 3.1%. Manufacturing PMI last month was at 57.6, came in at 55.5. PMI composite last month was 59.2. In December, came in at 56.4. And PMI services was expected at 58. Last month was at 58, came in at 55.5. So we see a bit of a slowdown in India, and it's not a negative because I shouldn't say it's a negative, but it's not going to take it negative because they still have robust exports. You are seeing inflation, which is starting to rear its head, but there should be 1 or 2 more months of fairly steady growth before we really get the hit on the services side. And I think that's what is going to be to watch. So I think we get one more nice little push. And this is giving you an idea. We had a nice bounce. Now manufacturing PMI can drift lower a bit, still remain well in expansionary territory, be fairly robust. But what we're looking at is the India services, where we think that's where we're going to see some of those issues, some of that slowdown. And that's the one that could get much closer to 50 faster as people struggle with inflation, with falling wages, and some of this underlying pressure that we continue to see in a lot of emerging markets and then it flares into something bigger as we've seen. We don't think India flares into anything much big. Obviously regionally it will, but not on a holistic level because it's going to be rural versus urban, and we've already seen the rural side protests. Some of that has been appeased. It'll probably come back again as diesel prices remain elevated, as crop prices become a pressure point when we look at demand, and as demand gets impacted, you look at vegetable oils, other food oils. We do see inflation as a big pressure, which is going to kind of cap that internal demand side, which is why services is going to be our tell for what that looks like. So if you have any questions, you can ask us and find us in the comment section or find me on my Twitter handle. Always happy to have a back and forth. We hope you're happy to have us back. If you can, please like, share, subscribe, send this to whoever you can, and have them support us because, again, we appreciate your support and we wish you a very happy and a very blessed 2022. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.